Ford is standing on the edge of a tariff tsunami, with $10 billion in revenue about to be swept away. If this ship sinks, consumers will ultimately pay the price. China's policies could lead to massive losses for Ford as they move to stop importing American cars, including key models like the F-150 and Explorer. In 2024, China accounted for 15% of U.S. automakers' revenue, with Ford expecting to bring in about $5 billion from Chinese orders. However, new tariff policies could cause Ford to lose up to 20% of their global revenue, approximately $5 billion annually. Additionally, auto parts imported from China will face high tariffs, driving up production costs by $2,000 to $5,000 per vehicle. This burden on Ford isn't isolated to China. The European Union is also ramping up retaliatory measures, restricting car imports from the U.S., particularly affecting Ford. The EU represents about 25% of Ford's export revenue, with major markets like Germany, France, and Italy contributing significantly. If these policies go into effect, Ford could lose between $3 to $4 billion annually, giving competitors like Volkswagen and BMW the chance to seize market share. Even more concerning is that the EU is crucial for Ford's electric vehicle, EV, development. Tariffs will drive up EV production costs, threatening Ford's position in the EV race. Rising production costs and raw material prices are forcing Ford to raise car prices by $2,000 to $4,000 per vehicle, making cars more expensive, especially for middle-class consumers. This will likely reduce demand for Ford vehicles, resulting in significant global revenue losses. If the trend continues, Ford could lose up to 30% of revenue from these markets within the next 1 to 2 years, drastically cutting profits. The U.S. auto industry faces a major crisis due to tariff policies from China and the EU. Ford's factories in Ohio, Michigan, and Kentucky are expected to cut production as export orders shrink, leading to potential job losses of 5,000 to 10,000, particularly in engine and auto parts manufacturing. The pressure from shrinking orders forces Ford to cut costs, laying off workers and reducing production, directly impacting manufacturing communities. Meanwhile, international competitors like Volkswagen and BMW are poised to expand their market share, intensifying the pressure on Ford and increasing U.S. unemployment. The supply chain is also being disrupted, pushing more workers into unemployment and worsening the economic crisis. Ford now faces a critical decision. Can they maintain their position in the U.S. auto industry, or will they be overtaken by international competitors? While Trump insists the tariffs protect American workers, Ford argues they are causing massive losses and calls for a more collaborative approach to achieve sustainable growth. Canada has delivered another devastating blow, throwing the U.S. auto industry into deeper crisis. In March 2025, President Trump imposed a 25% tariff on cars exported from Canada to protect the U.S. auto industry and reduce the trade deficit. Canadian Prime Minister Mark Carney retaliated aggressively, targeting critical sectors like electric vehicle parts, battery minerals, and auto components essential for companies like Tesla and Ford. This disruption caused U.S. auto plants to grind to a halt, delayed car deliveries, and triggered panic on Wall Street, wiping out $50 billion in auto industry value within a week. Car prices soared, and supply shortages made life harder for U.S. consumers. The trade war not only rocked the auto industry but also destabilized the broader U.S. economy. Forecasts show U.S. car sales could drop by 700,000 units in 2025, with car prices rising by an average of $5,855 per vehicle. S&P Global Mobility predicts that North American production could be disrupted by up to 20,000 cars per day, placing massive strain on manufacturers and consumers. Tesla, heavily reliant on Canadian minerals like nickel, lithium, and aluminum, saw its production lines in Nevada and California slow significantly. Delivery times stretched from 2 weeks to 2 months, affecting the production of 6 million cars expected in 2025. Tesla's stock plummeted, and investor confidence dropped, with firms like UBS and Mizuho downgrading Tesla's stock target by 11% and 6%, respectively. Ford also struggled, with over 25% of production at its Michigan and Kentucky factories failing to ship on time, leading to revenue losses and higher consumer costs. This crisis has driven car prices up over 15% within just a few weeks, making it impossible for millions of Americans to afford new vehicles. The used car market has boomed, with used trucks now sometimes priced higher than new vehicles simply due to availability. The broader U.S. auto industry, one of the country's largest job creators, is now facing a serious crisis. Over 50,000 workers lost their jobs within the first month after Canada's retaliatory tariffs took effect. Workers in Ohio, Michigan, and Kentucky are especially hard hit, facing economic instability and growing anxiety. This crisis is no longer just about retaliation, it's a real economic disaster impacting companies, workers, and consumers alike. Prime Minister Mark Carney has implemented a bold diplomatic strategy to elevate Canada's position on the global stage. Instead of directly confronting the U.S., Carney cleverly utilized measures like increased border checks, delaying shipments, and disrupting supply chains, putting strong pressure on the U.S. economy without resorting to brutal sanctions. This strategy not only helps Canada build an image of fair trade but also captures the attention of international investors. Countries in Asia and Europe, long tied to the U.S. economically, are now looking for opportunities to partner with Canada and Mexico. Automakers are taking note too, which could lead to a shift in investment away from the U.S. If that happens, America could lose significant influence in the global automotive industry. Meanwhile, a historic shift is unfolding in the automotive sector. China and European countries are seizing the opportunity to grab a larger share of the North American market. With access to critical minerals from Canada, China has begun investing heavily in the electric vehicle (EV) industry. Chinese EV factories in Mexico are poised to enter the U.S. market without facing tariffs, threatening the dominance of American automakers. Europe is also shifting investments from the U.S. to Canada and Mexico. Major European automakers, once loyal to the U.S., are withdrawing and seeking more reliable partners elsewhere. The growing competition from China and Europe means American companies like Tesla, Ford, and GM must adapt quickly or risk losing their standing. The pressure intensified when China shocked the world by slapping 125% tariffs directly on U.S. exports, cars, tech equipment, and semiconductor components, all sectors that contributed over $36 billion to the U.S. economy just last year. Tesla suspended shipments to China. John Deere lost over $2 billion in 2 days. Supply chains are being disrupted, and concerns are mounting over China's control in this new trade war. Adding to the tension, China began reducing its holdings of U.S. bonds, bringing its U.S. dollar reserves to their lowest point in 15 years. State-owned Chinese banks also stopped issuing credit in U.S. dollars, shifting instead to the renminbi and the euro for international transactions. China is quietly withdrawing from the U.S.-dominated financial system, preparing for a world where the dollar no longer reigns supreme. The U.S. is also witnessing its allies drift away. Countries like Canada, Saudi Arabia, and Germany are rebuilding their trade strategies independently, no longer relying on the U.S. Canada signed major deals with China in rare earths and energy. Saudi Arabia now sells oil to China using the renminbi instead of the U.S. dollar. A more multipolar world is emerging, with the U.S. steadily losing influence. China isn't just competing anymore, it's dominating. Alongside aggressive tariff policies, China is investing heavily in the EV sector, securing critical materials, building factories in Mexico, and reaching U.S. markets without tariffs. Companies like BYD and NIO are becoming dominant players, while Ford and GM struggle to maintain their market shares amid supply chain issues. The future of the U.S. auto industry looks increasingly uncertain. Meanwhile, the dollar's strength is fading. The Chinese yuan has captured over 6% of global SWIFT transactions. China is not just experimenting with the digital renminbi but is actively building an independent financial system. More and more countries are moving away from the dollar, signaling a massive shift in global economics. Switching gears to domestic satire, Melania Trump's new book received scathing reviews, with Vanity Fair calling it truly bad. But critics missed the bigger point. This wasn't just a bad book, it was a bizarre branding exercise, complete with the scent of Slovenian prenup ink. The irony of Melania leading an anti-bullying campaign while married to America's most notorious cyberbully was too much for late-night comedians like Jimmy Kimmel to resist. He, along with Jim Carrey, painted Melania as a reluctant, detached character in the Trump saga, a political horror movie directed by Donald himself. Viral moments, like Melania dodging Trump's hand with the reflexes of a trained escape artist, only fueled the mockery. Kimmel, with his surgical comedic timing, turned Trump into a living parody of himself, highlighting the former president's paper-thin ego and endless need for attention. Trump's furious Truth Social rants only validated the comedian's points, proving that no one does political tantrums quite like him. Economically, the U.S. situation has worsened rapidly. In just 8 weeks, the U.S. GDP forecast plummeted from plus 3.9% growth to a sharp minus 3.7% decline, the steepest drop since the COVID pandemic. Forecasts shifted grimly each month. 4 weeks ago, plus 2.3%. Last week, minus 2.8%. Now, minus 3.7%. Many economists believe that had Trump not imposed aggressive global tariffs, hitting allies like Canada, the EU, and Mexico, the economy might have remained stable. Trump's Liberation Day, the day he imposed the tariffs, is seen by many experts as more of a destruction day for the U.S. economy. Instead of protecting national interests, the policy caused severe economic disruption and weakened vital international relationships. Pairing Trump's unpredictable policies with Elon Musk's chaotic influence, many are now calling this the economic destruction triangle. And if that wasn't enough, Social Security is now being described by critics as the biggest Ponzi scheme of all time, highlighting deeper cracks forming in America's economic foundation. The global economic landscape is undergoing significant shifts as countries respond to U.S. protectionist policies, particularly the imposition of tariffs. These measures have prompted strategic realignments in trade, manufacturing, and financial sectors worldwide. In response to escalating tariffs from the U.S., European Union, and Turkey, Chinese automakers are aggressively expanding their overseas manufacturing capabilities. Bloomberg NEF reports that China's full-process manufacturing capacity abroad is projected to more than double, reaching 2.7 million units by 2026. This expansion includes establishing comprehensive production facilities, encompassing stamping, welding, painting, and assembly, in countries like Hungary, Turkey, Thailand, and Brazil. Companies such as BYD, Chery, and SAIC are leading this initiative, aiming to circumvent trade barriers and tap into emerging markets. Parallel to manufacturing strategies, China is also adjusting its financial portfolio. The country's holdings of U.S. Treasury bonds have declined to $759 billion as of December 2024, marking the lowest level since 2009. This reduction reflects China's efforts to diversify its foreign exchange reserves, with increased investments in assets like gold. Such moves indicate a strategic shift away from reliance on U.S. financial instruments, aiming to mitigate risks associated with U.S. economic policies and potential currency fluctuations. The ripple effects of U.S. tariffs are evident in global economic indicators. The European Central Bank, ECB, has responded by cutting its main deposit interest rate to 2.25%, the seventh reduction since June 2024. This monetary easing aims to counteract the negative impact of U.S. tariffs on EU exports, which have dampened business confidence and tightened financing conditions across the Eurozone. Similarly, the International Monetary Fund, IMF, has downgraded its global growth forecasts for 2025, attributing the slowdown to U.S. protectionist trade measures. The IMF highlights that these policies have led to retaliatory tariffs and increased global trade tensions, contributing to financial market instability. Traditional U.S. allies are reevaluating their trade relationships. Canada, for instance, is considering producing the next-generation RAV4 SUV domestically to mitigate the impact of newly imposed 25% tariffs on imported vehicles. This shift underscores a broader trend of countries seeking to reduce dependency on U.S. markets and explore alternative partnerships. In summary, the global response to U.S. tariffs is reshaping economic alliances and strategies. Countries are diversifying manufacturing locations, adjusting financial portfolios, and seeking new trade partnerships to navigate the evolving economic landscape. The global economy is entering a period of intense restructuring as nations adapt to the sweeping impact of U.S. tariffs. These protectionist policies are not only reshaping trade patterns but are also forcing governments and corporations to rethink supply chains, investment strategies, and diplomatic alliances. China's aggressive move to build vehicle manufacturing plants overseas highlights the scale of this shift. Companies like BYD, SAIC, and Chery are investing billions in new factories in Europe, Southeast Asia, and South America. BYD's plant in Hungary is set to produce 150,000 vehicles annually, aimed directly at European markets to avoid tariffs and reduce shipping costs. Meanwhile, Chery has announced plans to open a major facility in Spain, using it as a hub for broader European expansion. By manufacturing locally, these companies hope to sidestep the growing web of tariffs while positioning themselves closer to key consumers. This wave of expansion is not limited to manufacturing. China's divestment from U.S. Treasury bonds reflects a strategic reallocation of reserves into commodities like gold and oil, assets less vulnerable to U.S. policy swings. The People's Bank of China has reportedly increased its gold reserves for 17 consecutive months, a clear signal that Beijing is preparing for a prolonged period of financial decoupling from Washington. Europe is simultaneously dealing with internal economic pressures worsened by the tariff battles. The ECB's rate cuts aim to prevent a deeper recession, but many analysts warn that monetary policy alone may not be enough. European exporters, especially Germany's auto industry, face significant headwinds as American tariffs make their products less competitive. As a result, German manufacturers like Volkswagen and BMW are exploring production increases in Mexico and South Carolina to maintain access to the lucrative U.S. market without being hit by tariffs. At the same time, political consequences are emerging. Canada's move to prioritize domestic production of key vehicles as part of a broader, Made in Canada, strategy, signaling that Ottawa is preparing for a long-term cooling of trade ties with the United States. Mexico, benefiting from its position in the United States-Mexico-Canada Agreement, USMCA, is aggressively marketing itself as a manufacturing hub for companies seeking tariff-free access to the U.S. market. In Asia, nations like Thailand and Vietnam are attracting major investment as alternative manufacturing bases. Thailand's Board of Investment has reported a record number of applications for new factories, especially in the automotive and electronics sectors, as companies seek to diversify away from China and mitigate tariff exposure. Financial markets are reflecting the anxiety created by these shifts. Global stock indices have been volatile, with investors increasingly favoring assets perceived as safe havens. Analysts forecast that if the tariff war intensifies, it could shave off up to 1% of global GDP growth in 2025, a significant slowdown that would affect employment, corporate profits, and consumer spending worldwide. Overall, the world is bracing for an era of fragmented globalization, where regional blocs strengthen and cross-border economic friction becomes the norm rather than the exception. U.S. tariffs have triggered a realignment that is redrawing the global economic map with lasting consequences.